we are seeing a turmoil in the markets across the world. Donald Trump has come and imposed a 26% tariff on India, a 100% tariff being imposed on China. I think the bigger question that people ask us is what next? Hello and welcome everyone. Now that we are all aware of the new tariff policy that has come from Donald Trump, we are seeing a turmoil in the markets across the world, right? We are seeing crashes in the US markets, crashes in the Asian markets, and a lot of turmoil even in the yields and the currencies. So while we're all aware of what is happening, right? It's very unpredictable the way the market is moving. There's a lot of uncertainty if you actually look at it right now. Nobody knows how long will these tariffs continue. Will they be revoked, or will they increase? So there's a lot of uncertainty in the market. But I think the bigger question that people ask us is what next, right? What are you going to do with your strategies to do better than the market in the future, right? What are you going to do to handle the uncertainty? So this week we thought that we will actually go through what our plan for the market is, right? During the last 3 months, while the market has been volatile, we've seen obviously a lot of client queries, but it's a very different environment from a bull market, right? You get a lot of chance, a lot of time to actually spend on research because the volumes are low. There's not a lot of activity per se in terms of picking stocks, right? So we've taken a lot of opportunity to research on how to best prepare for the upcoming market. What are the methodologies do you apply to avoid risk? What are the methodologies to actually pick up winners in this market? So in this video, we'll be going through, our analysis of what's happening in the market and how do we want to participate in this slightly risky time. So before we go over what we are going to do, let's talk about the macro changes that have happened. So in such scenario, many clients will come and ask us, what is the data telling you? See, the data is giving us a strategy, but the data right now cannot predict what's going to happen next. The predictability is only coming from the policies which seem to be very, very uncertain. Donald Trump has come and imposed a 26% tariff on India. Along with it, he's put massive tariffs on different countries across the board. China has been put on 34% tariff, and even European countries have been imposed with very, very high tariffs, right? So that would really change the world order. That would change the way the world trades. For example, Apple makes most of the iPhones in China, and with now 100% tariff being imposed on China, Apple can no longer do that, and maybe some of that business will come to India, in fact, right? So there's a lot of things that are changing, and people are sort of speculating. I think we covered it in our last video also, that in case that these tariffs stick, the goods and services in US will become more expensive. Small businesses which actually manufacture a lot from, let's say, China, India, Bangladesh, in different countries will be imposed with tariffs, and they will lose out on business or lose out on their profitability, right? A lot that's going to change. The big fear for India, because we are not a biggest exporters, would be that these tariffs could cause a recessionary environment in the US. I think that's the bigger fear that people are living with, that if the US market goes to recession, if there is slowdown in the global economy, that would have second order effects on India. Obviously, that's a long-term thing, and a lot could change. A lot of negotiations could happen. A lot of policy changes could happen before that. But those are the fears that we're living with. In terms of the market conditions, what do we expect from here? Do we expect another large crash? Do we expect the market to bounce back? See, it's again uncertain. But what we really believe is that there will be companies in this environment that will be highly resilient, right? And that is where you can actually generate alpha as well. So this video, we're going to understand the research that we have done recently. How do we actually avoid companies that can cause us big problems in this environment, and how do we pick up companies that can actually have an alpha in the current environment? So the first thing in the bear market is understanding what to avoid. There are certain very, very clear risk signs that companies show that can be highly detrimental in a bearish market. So the first step to do would be to understand what are the warning signs that can help you avoid these minefields, these companies that can have very, very adverse price reactions in a bear market. So the first warning sign that we want to look at is the liquidity stress, right? There are various companies, that have very limited liquidity, right? So what happens with these companies is that even with a very small volume movement, the price impact can be very adverse, right? So even with a very small set of investors selling that stock, what you would see is that the price correction can be very, very sharp. So in a scenario like this, where, on any sudden global news, there can be big panic and a panic selling, you have to avoid stocks with very high levels of illiquidity. So having filters around that would be very suitable. How do you measure illiquidity? So there are various metrics that we sort of look at. There's something called Ahimud illiquidity, which measures the price movements with volume movements, and that's a very good measure that helps you weed out illiquid stocks. Apart from that, there are other metrics also. For example, you could look at the trading turnover ratios. What that means is we are measuring the volume that are happening in the market in comparison to the number of shares that are outstanding. So any company that sees a lot of volume movement, but it has limited number of stocks that are outstanding, obviously there's a lot that is happening for that company. So to give you an example about illiquid stocks, right, from the recent times. So illiquid stock right now, which has seen big impact, the examples would be something like a Garware High Films. This stock in the plastic segment has seen very big price impact, even though the fundamentals remain strong, and that is because of illiquidity. Similarly, if you look at a stock like Netweb or Anantraj, these stocks, the most of the impact that they have actually seen is because of the illiquidity that these stocks have. And obviously that is not to say that these are not strong fundamentally, but because of this illiquidity constraint, they will tend to have some wild up moves and down moves, and that's why people have to be careful on how they handle these stocks. If you're looking at trading turnover ratio, again, a stock like BSE in this environment, you can see the amount of volume buying and selling that you're seeing compared to the price movement, and you can see there's a high amount of volatility in that particular stock. And in a sentiment hit market, I think it's good to avoid stocks that have very high trading turnover ratios. Another example here would be IndusInd Bank. Again, a very adverse news came, and you can see the amount of volume that is moving in that particular stock, right? So that's another big trigger to understand illiquidity and the impact of volume movements in these stocks. Now, the second type of warning sign that comes is around the price volatility. What you would see is that for certain stocks, the prices suddenly become very, very volatile. There are a lot of up and down swings, right? And this could be irrespective of the illiquidity and the turnover, right? So such stocks should be avoided in a bear market. So what happens with these stocks is that the sentiment is moving very rapidly before the fundamentals can show what's happening in that stock, right? So there's a sentimental hit that is happening that's leading to a lot of volatility, and that's a warning sign, and that gives you a clear indication that you should be avoiding such stocks in a bear market. So all these metrics, we actually have done our analysis. We have sort of tested out how do they impact stocks in a bear market, and filtering with this, does it impact or improve the portfolio performance? Yes. If you actually avoid illiquidity, if you actually avoid volatility, that improves your performance in a bear market. Now, another thing that you have to really look at it in a bear market is financial distress, right? Companies that are facing some sort of a distress in their financials. So obviously financial stress can be of various forms. You could actually look at debt levels, you could look at operating leverage, you could look at a number of other indicators. For example, how well the companies manage the inventory, how are their receivables moving, how are their payables being managed, what is their cash conversion cycle, how are they doing capex, is that capex sort of comparing to the assets that they have. So there can be various things that help you understand the financial situation of a company. But apart from that, you can actually also look at some big bankruptcy risks, right? There are a number of measures that we track, and some of them are very, very well known also. For example, the Olson score or the Altman Z score. These scores actually combine various distress metrics. So profitability, the asset turnover, the inventory turnover, a number of such ratios, their leverage is combined, and they come up with this measure which gives you an indication what is the amount of distress in that stock. And above a certain level of distress, you should be avoiding those stocks in a bear market. See, that is not to say that taking debt is wrong or taking any sort of leverage is wrong, or sometimes companies go through slightly lengthy cycle due to exceptional reasons. But these are some clear warning signs, and extremes of these ratios will help you avoid stocks that can actually be very, very volatile in a bearish market. Now, another thing to do is to avoid valuation traps. See, valuation is something that we hear about a lot. India is at a slightly high valuation, or some companies are selling at a high valuation. Valuation for people who have a momentum bent can be a difficult thing to sort of deal with, right? When you are doing momentum investing, then you actually want your valuations to go higher, right? Instead of PE ratio, you start looking at EP ratio, which is the earning yield. Is the company actually increasing the earning yield or not? But even the valuation ratios can give you very, very clear signs in a volatile environment, right? So a metric to look at would be that you could compare the valuations, which could be in terms of PE ratios, price to sales ratio, price to cash flow ratio, earning to EBITDA ratio, a number of such ratios compared to their 5-year averages, right? How are they comparing compared to their 5-year averages? Is there a very, very material differentiation? Putting hard limit on 15 PE or 16 PE is very speculative, I think, but looking at long-term averages and sort of moving around that makes a lot of sense. Similarly, comparing these ratios with the industry average is a much, much clearer sign, right? So is the PE ratio for this company very materially higher from the industry, right? Is the price to sales ratio materially higher from the industry? That gives you a very, very clear sign that, okay, this company could have some valuation trap, and those could be some of the stocks that you could avoid, especially at very, very high deviations in a bear market. And finally, we talked about capital efficiency, right? So, warning signs on the cash conversion cycle, which mean how well is the company, if it is in the manufacturing or in the goods industry, how well are they managing the inventories, their receivables, their payables, and the accruals that come into the picture. So looking at that and looking at the capital efficiency ratios, their return on earnings, their return on assets, their return on capital employed, right? There are a number of ratios which you can monitor, and if a particular company acts very adversely on these ratios compared to its peers in the industry, that can give you a clear warning sign to avoid that stock in such an environment. So those were some of the warning signs that you have to really look at when you're investing in a bear market, right? When you're investing in a time when there's a lot of risk. And that is something that we are inculcating in our strategies, putting out filters on illiquidity, putting out filters on capital efficiency, valuations, volatility, etc. But having said that, now that we've understood what to avoid, where do we go and actually invest, right? That's the second question. So where do we invest in a bear market? So the first thing to note is that the bear market does not reward exuberance. In a bear market, in fact, a good strategy would be selling any stock that has run up a lot. It could be due to valuation measure, it is just because of profit booking. But the bear market sort of actually gives alpha to companies that have higher quality. Companies which can compound their earnings at a consistent rate. So any company, for example, which has given a very good return on equity, right? Which means how do they compound earnings consistently compared with their equity? That's a very, very good company to hold on to in a bear market, because that this company will keep on growing the earnings at a consistent pace. Similarly, a company that can give a very good return on assets or return on capital invested is a very, very interesting measure to actually look at. It really filters down and gives you a good set of companies to evaluate, right? So for example, companies which are very traditional in nature, or which might not have very strong news triggers or growth triggers, but if you actually go and look at the business, they generate a lot of cash, they generate a lot of earning consistently because of their very, very optimal value chains. So examples here would be, for example, a stock like Pidilite, Asian Paint, or Berger Paint, like with the strong value chains. Obviously, there are external factors that impact these companies also, and this is not a recommendation to buy or sell any stock, but focusing on companies that have reliable earnings, that have a very good history of compounding their earnings would be a very good idea. If you're looking at an emerging industry where you might not have a lot of history, looking at some other efficiency ratios, right? For example, the current ratio, the flow ratio, and a number of other these quality metrics can help you identify stocks that might be in a better financial situation compared to their peers, right? And that is something that you have to keep in mind, and that has to be a focus area when you're looking to invest into this market. When you're looking at high quality companies, typically it makes sense to avoid any sort of leverage and stress, right? So any company that is highly leveraged in this environment, and if let's say the situation worsens, if there is a decline in growth rates, that company could see a higher impact. So in such an environment, focusing on good financials, low leverage, and sound business models would be a very, very reasonable thing to do. So as an investor, you have avoided your minefields, you've avoided the warning signs, and now with the companies that are left with you, how do you choose which companies to invest into? So to choose the companies to invest into, number one, we are putting a bias on quality. We are putting a bias on how well they capitalize on their assets, on their investments, right? And second thing that you always have to look at is the expectations, right? What is the expectation of earning from this particular company? Now, obviously, after filtering out the company based on their quality and how well they're managing their financials, you also actually have to go and focus on the expectation from the industry, expectation from the company, and expectation of earning that you're going to see from this particular company, right? What you will see is that even though the market has been volatile, it is awarding stocks that are able to give good earnings, right? For example, recently we saw Transformer Rectifier India Limited, Trill, sort of come out with exceptional earnings. This happened this week only, and after that earning, in a very bearish day, you saw that the particular stock was up. People were still buying that particular stock. So because the market will still award companies that have good earnings. And even if some of the companies that you're looking at which might be illiquid, where you are seeing some up and down sharp movements, if they are able to generate good returns on earnings, right? If they are actually able to deliver good returns, if analysts across the board have strong expectations around it, if their forward-looking PEs are still reasonable, if their forward-looking ratios are looking attractive, that is something where you have to focus on. So having a focus on expectations, be it from your own analysis, be it from the market, right? Having an eye out on expectation in this market is very, very important. And the third thing, obviously, Wright research, we do focus on momentum. I think, combining momentum with these factors makes them extremely powerful, right? So looking at how the market has been sort of receiving these stocks, right? If they have a positive trend, be it in the short term, be it in the long term, or in the very, very long term, it's very important when you're picking stocks in this environment. Looking at how resilient that stock has been due to any sort of price movement, right? You could have seen that, okay, the stock saw some correction when they were panic selling, but if the stock picks up strongly, if the stock shows resilience and momentum, that's a very, very strong signal that, it's an interesting stock and you could include it in your portfolio. So in this environment, we have explored multiple strategies, combining, let's say, doing fully momentum investing, looking at a combination of momentum and quality, looking at a combination of momentum and value. And right now in this market, what we see is a combination of quality, momentum, and expectation tends to be a winning sort of a thing. And in fact, we have done our backtest and we've analyzed this different factors even in 2018 market, right? And what you would see is even in such a volatile market like 2018, a strategy that follows these factors would in fact have done better than the market, would have actually given you a higher alpha compared to the market, despite all the volatility. And you would see that it would have slightly lesser volatility compared to a momentum strategy, but it would be a winning strategy in the longer term. So as a focus area across our different portfolios, you will see that there's a tilt that is happening on a combination of quality, low volatility, momentum, and expectations. And we have sort of enhanced our filter metrics that help us weed out the stocks that can throw out some wild price moves in this environment. So our approach to the bear market is rooted in our research and experience. We have drilled a lot into a lot of data that gives us confidence on how to invest in this scenario. We can see that including a bias to quality, including a bias to momentum in this scenario can actually help you pick winners. And short-term movements, they can happen, but as long as you're holding strong stocks, that will give you an opportunity to generate long-term alpha. Obviously, the environment right now in the world is highly volatile. Due to the trade war, we've seen a bear market, and maybe we'll see a sideways market for a while in the future. Right? We can see a lot that is happening between China and the US, and that will have an impact on the global value chain. But I think having a bias towards strong quality and picking up some winners based on their momentum and expectations can actually generate alpha even in the current market. We've had a lot of time to look at our research methodology. We've done all these experiments trying to understand how these metrics impact stocks, looking at a lot of historical data, and we have modified our methodology to put out filters on these metrics that can help you identify stocks to avoid, and also metrics that can help you pick up stocks that can give you enhanced returns. And this comprehensive strategy continues to guide us. So if you are looking to really get a gist of the philosophy to follow right now, number one would be to avoid stocks with illiquidity, avoid stocks with very high volatility, and warning signs on the balance sheet because of valuations or because of their capital efficiency. Second is having a focus on quality, looking at companies that utilize capital really well, that generate money from the capital that they deploy, and they manage their cycles really well. Secondly, picking up sectors and industries and stocks where you see strong expectations, right? So even in a volatile market, you are seeing strong expectations from sectors like the hospital segment that continues to do well. You're seeing very strong expectation in the, let's say, AC segment, right? Where with the hot season coming up, there will be a lot of demand for ACs. You're seeing expectation even in the agriculture segment, right? Where India is seeing an uptick. So having a focus on expectations plus keeping an eye out on momentum, not just focusing on very short-term momentum, but looking at long-term momentum and trying to pick up these long-term winners, keeping a focus on momentum, understanding that momentum has no one single definition. There are multiple cycles, there are multiple ways of momentum. Sometimes you have to be very aware of volatility compared to momentum. Sometimes you have to look at the longer term and short-term term cycles combined to pick up momentum. Having that focus is very important and will be important in the current scenario. And finally, being flexible, being ready to change your allocation if something big changes in the world. For example, nobody anticipated 26% tariff, and that could impact your holdings in a very, very diverse way. It does not destroy the market, but it will have an impact on certain industries. So having that flexibility to adapt and be ready to change in this environment is also very important. So while a lot of people were disoriented from momentum when the volatility started, right? They thought that momentum has had such a good run, and systematically investing with momentum might not give you returns. No, momentum can take various forms, and the biggest thing that you can actually do is follow a disciplined approach. And in such an environment, your disciplined approach also have to have a focus on fundamentals, which comes from strong quality of these companies, right? Putting a focus on how the price movement is happening, what is the amount of speculation that is happening in that particular stock. That's also extremely important. So what we really believe is that systematic investing, having a focus on momentum along with strong fundamental, continues to remain a strong and a winning formula that would even give you a strong performance in any sort of volatile environment. While we cannot control these shocks, we can control the fragility of our portfolios, and we can control that we are looking at sectors where there is a very strong and solid expectation, and that would be the formula that we would be following in our strategies, and that is the formula that we recommend that investors follow in their strategies also. By focusing on a fundamentally sound portfolio which has a forward-looking bias on the market, forward-looking bias on earnings, with a strong look at the technicals through momentum, can be a winning formula and can actually give you resilience in the current market. So that was our video on how we are investing in the current market. If you like this video, please do hit the like button, subscribe to our channel, and write down in the comments what you like about the video and what you would like us to cover next. So we will see you in the next video. Till then, happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.